When I think about the opportunities for China, the structural change, the reforms that still need to be made, I remain constructive of those opportunities. There are clearly headwinds and difficulties tailored around the changing political environment here in China, but the potential, the sheer scale of the markets here in China lead me to believe on a 5 and a 10-year view that clients should be looking to China as a very underheld, underinvested investment opportunity.
Our view is that in coming years we could see some really quite significant shifts in the way that China equity products are constructed. Fundamentally today, the way that most China equity funds are run are really quite similar to 25 years ago. They're benchmarked against the MSCI China Index, which uses a universe of stocks of 8 shares listed in Hong Kong and increasingly ADRs listed in New York. Now, one of the things that's happened over the last 2 or 3 years, whereas the news headlines have concentrated to a large extent on the capital market volatility, behind the scenes there has been a really significant pickup in the pace of financial reform in China. And what this means is that for the first time, China's domestic A-share equity markets are becoming increasingly accessible to global investors who no longer need the cumbersome QFII quotas to access onshore markets. Over time, A-shares are likely to be included in MSCI indices. But perhaps more importantly for us as active bottom-up stock pickers, the A-share universe has a far greater opportunity set in terms of some of the new economy sectors which we believe will be the future growth drivers of the China stock market. What does this mean? It means that in the next 2 or 3 years you should expect to see an increasing allocation to China A-shares in our Allianz China equity products, and also the development of new investment solutions that can invest flexibly across China A, China H, New York, and other China equity products.